We've had some pretty good volatility here in recent months, and I guess I'd kind of like to get your perspective, Brian, on how that's kind of looked in the market. Has everything been orderly? Has there been anything kind of weird that you've seen, or what's kind of been going on?
Yeah, I'd say in terms of the orderliness, I've been kind of surprised at how orderly things have been, right? I mean, you think about obviously what was this, April 8th, April 9th, around that time when, the unwind, so to speak, of the tariff talk, that those obviously were pretty crazy days. But overall, I feel like things have been a lot more stable and the market, rallying back as much as it has kind of caught me by surprise. I think I'm probably not the only one who got surprised by that. But, I think you also see during periods of large drawdowns both in crypto and in equities, right? Then there's also potential for gigantic up days during those periods, right? Where you have these 8-9% up move during those times, more in crypto, right? It's definitely stuff that happens every couple of decades, not every couple of weeks, right?
Yeah, absolutely.
One thing that I kind of observed, and maybe you can validate this is true or not, but when we're experiencing those larger drawdowns after the Liberation Day announcement, we were, the markets were opening up with huge gap downs, especially on that, it was a Sunday night or the Sunday evening open that we saw a particularly large gap down. And it just kind of felt like there might have been like lower volumes just because of the way that things were just moving. Did you guys notice that? Or is that just me extrapolating in my own mind a bias just by looking at some of these wonkier candles that were kind of forming on intraday basis?
Yeah, I think that it takes a while for news to settle in where I think, every participant pulls back, right? You think about something like the volatility you saw last August, right? Where that was kind of, with all the, volatility around like the assassination attempt in July and August, right? And how crazy those things were. That was something in the market wasn't like really expecting at all. And things like were very disorderly, right? Whereas I think this time the market did know that tariffs were coming. I think there's the extent of what they were was what surprised people. And so I think that even with as large of moves as they weren't as disorderly as they were back in August, which was, interesting to me, right? Because it was in the back of people's minds, I think, that this dislocation could happen.
Yeah, I think the investors were hoping that the sequence of events were going to be different and tariffs were going to be like the last thing that the administration would focus on, being, deregulation and tax cuts being up at the top of the list. But
Yeah.
I guess we've switched the order, and that's been kind of just the reality that we're dealing with. But like you said, it's totally reasonable to assume that that a lot of this to some degree should have been expected because
Right.
you were listening to many of the promises made that this would be one of them. So
One thing I wanted to put to you, Brian, we were lucky enough recently to have David Lawant, who's head of research at FalconX. And he observed, in his view, the reaction, probably more so in the realized volatility from Bitcoin rather than the implied volatility, but also in the implied volatility as well, was noticeably, palpably more mild than for previous drawdowns. I mean, he actually delineated, with quite some quite compelling stats to suggest that basically you could interpret it as that the market becoming more mature, capable of withstanding shocks, more
Yeah.
liquid, all that kind of stuff. What is your observation? I mean, maybe you think these are like they're extraneous factors to, and obviously one data point doesn't necessarily prove anything. But what's your color on that?
Yeah. I mean, I think that, the volatility we're seeing in crypto is much lower than it was in the past, just because I think we've traversed a lot of these paths, price wise before, right? Think about when, Bitcoin was on its way up from 60,000, 70,000, 90,000, 100,000, right? Like the market had never been there before, right? So we're going across ground that we've already crossed before, and I think that there's less question about like, well, is Bitcoin going to be at 500,000 tomorrow? I think that it's more established trading ranges, and I think that therefore volatility is moving in a more or less unpredictable way. I don't want to say predictable, but less unpredictable,
Yeah,
right?
yeah,
And I think
yeah.
that people are starting to understand, okay, like what is a reasonable level for Bitcoin volatility, right? It's not 100 implied volatility like it used to be, right? It's a lot lower, and probably will never be what a Nasdaq or an S&P is, but I think that we'll settle in a range that is like a lot more realistic relative to where realized volatility is, right?
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken Adelaga, Head of Content, and as usual, I'm joined by my colleagues, Gabe Selby, who's Head of Research, and Mark Pilipchuk, who's our Research Analyst. Hi, gentlemen.
Hey, Ken.
Hey, Ken, great to be here.
And today we have a particularly special episode because we are also joined by Brian Burke, who is a Senior Director of Equity Products at the CME Group. Brian, we are really grateful for you for joining us.
Thanks, Ken. Appreciate it.
Right. And the reason why we have Brian today is because clearly, I think, some of you may know, some of you may not know, is that regulated Bitcoin derivative contracts have arrived in crypto surprisingly early for some people's reckoning, with CME Group listing Bitcoin futures in the winter of 2017. Since then, of course, Bitcoin, Ether, and most recently Solana futures have played an almost inestimable part in the gradual maturation of the asset class and the space. And CF Benchmarks has been a partner of CME Group right from the very beginning. So there's a lot to talk about, particularly with the recent launch of Solana futures and the announcement last week of XRP futures, which are coming May 19th, pending regulatory approval. So we've got plenty to talk about. So I think maybe, Brian, the way to get into this is that obviously we saw Solana futures, I think it was about a month ago now, come into market. And maybe a couple of weeks afterwards or 3 weeks afterwards, we had the announcement that XRP futures would also be launched. Now, the difference is, of course, is that the gap between Bitcoin and Ether futures, for instance, was, I think, something like 2.5 years, 3 years, something like that. So we seem to be getting a quicker cadence. And the other thing is, of course, we had the immediate launch of both a larger and micro, if I'm getting the terms wrong, forgive me, futures at the same time. So does that represent a deliberate quickening of the cadence of the launch of these novel crypto assets on the CME?
Yeah, I think that, there's a couple things going on here, right? I mean, we've seen that crypto markets certainly maturing. They're becoming more resilient, more widely understood, right? And I think that, with that environment, there's a lot more clarity for us to, move at the appropriate speed with these new product launches, right? You think about where the development was when, the first Bitcoin futures were launched, that gap between futures and options, as you mentioned, just much wider than what we're seeing with subsequent launches when we launch Ether options and micro products, right? And I think as we get more and more clarity and the marketplace gets more and more developed, that timeline's compressing a little bit, right? But I think the most important thing from our perspective is that our position is like, we're only bringing products to market if it solves a real risk management need for clients. And, we want to make sure that, like, as a, regulated marketplace, we're, providing access to those most liquid, most accessible products, right? When you think about Solana, XRP, right? These are providing access to the rest of the top 5 of market cap products, right? In addition to Bitcoin and Ether.
I just want to say, when we look at the data on the Solana futures that just recently launched, they seem to have exceeded expectations out of the gate. What do you think is fueling that demand so quickly, particularly in this moment that we were just talking about in the open, where we've seen a lot of uncertainty, there's been a lot of market volatility, but is there anything that's standing out, particularly with Solana?
Yeah, I mean, I think that the differentiation of a new type of coin, right, that provides something, different, right? Solana has the proof of stake, proof of history, consensus mechanisms, right? And, has complete transactions, 65,000 transactions per second. So this, lightning fast processing time, I think, is a differentiator, right? It provides like unique value for customers. So, again, want to be providing something that provides a legitimate hedging need, provides something different. And I think it just brings, more diversified marketplace about for us.
Yeah, that makes sense. I wanted to also ask, maybe just to kind of give us a little bit of a background on the CME suite of products. When we look at the derivatives from the equity side, which is more of where your background's been focused on traditionally, and now we've seen, more of a focus on these crypto futures. How does the client mix differ? Is there a difference in the client mix, or are, these hedge funds that are, more focused on the crypto side, whereas you might find more traditional, maybe market makers or broker dealers, right? Maybe just give us some color on that.
One thing that's fortunate about the seat that I sit in is that I get to kind of interact with both those marketplaces. Think about some more traditional finance players that are more focused on, our flagship equity indices, and those options versus the crypto native players that are focused on Bitcoin and Ether, right? And you get to take some of those lessons that you learn from either one. Like let's say we learn some sort of lesson from S&P or NASDAQ options, right? We can apply that for crypto where we're not reinventing the wheel. Likewise, we find a lot of times we want to try out something new and innovative, right? We have a lot more leeway to do that in crypto than we do in some of those other traditional products. So there's a nice back and forth where we get to leverage benefits from both of those. So for instance, like when we launched the Bitcoin Friday futures, traditionally we had the big contracts, the standard size contracts were expiring to the BRR, the Bitcoin reference rate, London close. Whereas with Bitcoin Friday futures, we could test the waters, so to speak, on appetite for the New York close with those products, right? So I think that's the type of stuff where we have a lot more flexibility to move a little bit faster with crypto than we do with some of the other legacy products, which is a great ability to have.
Absolutely.
One of the kind of cool things about those Bitcoin Friday futures is that they're smaller, and then I've seen them offered on like retail brokerages like Robinhood and kind of targeting that audience. Is that something that you'd be looking to kind of lean more into? And what's the kind of end
Yeah.
state with that opportunity? Is that like the big opportunity set for you all right now?
For sure. The retail trader, I think, is something that we're like very laser focused on, but we know that we have a lot more work to do to increase the accessibility of futures and options markets to the retail trader, right? So, the way I was describing to people about retail and futures and options is that there's a steeper learning curve, but once people understand the benefits of futures and options in terms of like margin efficiency, round the clock liquidity, it could be 60/40 tax treatment, pattern day trading rules, all those things that are differ with futures versus more traditional products. You can think about, a Bitcoin ETF, right? Our view is that there's a marketplace for all these products, right? And that like the growth of the ETF ecosystem has been like fantastic for us. But accentuating those key benefits of the crypto futures, I think it's been, a big focus for us for retail.
Yeah, and Brian, we talked a little bit about Bitcoin volatility and volatility in general at the top of the program in the sort of freeform part, and obviously VIX, which has been in the news recently, literally on channels which aren't even financial. I've actually heard the VIX being mentioned. And I think one of the curiosities about this market for a lot of participants and maybe people outside looking in is, do you think we're at the stage yet where increasing CME crypto option market maturity, we might be at a stage where CME Bitcoin options, the depth of that market is sufficient to begin to serve as an underlying basis of a robust regulated CFTC volatility contract, maybe? What's your view on that,
Yeah.
that question?
Yeah, I think that we're certainly getting there. I mean, what we spoke about before about the timeline between Bitcoin futures and options and then subsequent products. I think there's a similar analogy here. And we think about the volatility indices, right? And how the first adoption of any volatility index, widespread was in the 90s. And then you had futures in 2004, call it, and futures options in 2006, then ETNs in 2009. This is a multi-decade evolution for the volatility ecosystem for like variance swaps, that type of stuff around S&P and NASDAQ products. It's certainly not going to take 30 years for that to happen with Bitcoin, right? So I'm not going to give a specific timeline, but there is nowhere near that long a timeline.
They cross my mind.
It's going to be a lot quicker than that, right?
Yeah. No. So obviously, the basis of that question is that we do have, in partnership with you guys, we have the only pure measure of CME Bitcoin volatility, BVX we call it, the CME CF Bitcoin Volatility Index. And, we were obviously curious about the demand or your perception of the appetite for a product like that for all sorts of use cases that I guess, are quite analogous to how the VIX is used as well.
Yeah.
So you're saying it's like, it's coming.
Yeah. I think there's certainly appetite for it. I mean, I think a lot of our customers have gone from saying it might be a little too soon to, I think the marketplace is getting developed where it's starting to make sense to look at it, which is really promising, I think. And, for us, we're focused on not only, there's been so much talk about like zero DTE options across the marketplace, right? We're not only focused on the short dated stuff, but you think about Bitcoin, a lot of our institutional customers are asking us for like longer dated Bitcoin exposures. Right. So I think that there's a lot of different angles here, right? It's trading volatility, it's short dated stuff, it's long dated stuff, because people have, legitimate hedging needs where you think about this environment, you don't know what the world's going to look like 9 months from now. And people want to hedge that risk in crypto, which is pretty exciting to see that we can build out that longer part of the curve too.
That reminds me, Brian, and I'm not even sure if if it completely slipped my mind, but obviously we know this, well, we call it perpetuals, but it's not necessarily as perpetual. It's like spot quoted futures. I don't know how much you want to talk about that, if at all.
Yeah. So my colleagues on the team have been very focused on this. That has not been my focus area, the spot quoted futures. However, as part of the team, I can certainly speak to how they work. So the way it works is we were trying to bring wider access to the retail marketplace, right? And I think that critiques we've gotten or feedback we've gotten from retail traders in the past is difficulty in understanding the basis, right? The basis is the difference between the futures contract value and the spot. And then the other feedback we got is on rolling the contracts. Sometimes retail traders said they, are confused about the roll process or view it as, onerous to understand. So we tried to kill two birds with one stone with this product. I guess three you can call it. Is number one is making an even smaller contract. That'd be the first, smaller than micros.
Yeah.
Next is to make it so that it's a longer dated contract. So there's not the extent of rolling that you would expect in a quarterly expiring future. And the last part is
it's 5 years, isn't it? Something like that. Is it
exactly,
5 years?
Exactly.
Yeah, not a nominal long amount
right.
that no one's
right.
going to
It's not,
basically
30 years or something like that. Yeah. So, and then the last part is the basis, right? The way we do the basis is, as you'd expect from the name, it's spot quoted. So think about something like, let's say Bitcoin's at 100,000 spot, but with the carrying cost, interest rates and other, inputs, the future, let's say, is worth 101,000. Just picking easy numbers, right? The way it would work now is the price to be quoted is 101,000 for a traditional futures product, whereas for the spot quoted, it would be showing as 100,000 to the user. So it'd be no different than what they see for the spot product. Now that basis, that performance is still there. What we do is we add in that basis ourselves at the end of the day, and changes in basis are kind of like managed by the exchange in the background. We're doing a lot more products like this where we kind of like handle all that operational stuff in the background. There's full disclosure about what it is. We publish every day. This is what the basis is. This is how the basis changes, so you can track your P&L. So what's cool about it is you get the same performance that you'd expect with the future. You just don't have to do all the math of understanding the basis if you would prefer not to. So you get the benefits of it, but you don't have to do all the figuring of the basis, so to speak.
Yeah. It strikes me that, well, I mean, my background is FX after I was a journo, but foreign exchange, retail, and specifically, obviously, pertaining to Europe and the UK, CFDs, so contracts for differences, and which are basically total return swaps, posh word for it. Now, the way these generally work, there are a few exchange listed CFDs in Europe and the UK. Most of them are OTC, and generally, there's a culture in Europe and the UK whereby you basically just take what your broker, you obviously if you're smart, you read the fine print, you know that it's going to be calculated every day, whatever basis, but you just basically accept what the broker has decided or the platform has decided that's going to be your financing costs. So there's a lot more of a culture of understanding of how that is acceptable, in other words. So are you anticipating from that? Because I know that obviously they've been not necessarily eligible as, to be traded in the United States for decades, right? For probably forever, right? So are you expecting any cultural differences in terms of the sort of like habituation process relative to Europe and other parts of the world and maybe the US in terms of these oncoming spot quoted futures, or what's your view?
Yeah, I mean, I think a lot of this is about education, right? I think about what are my jobs here to the exchange, and it's launching new products, it's providing information, marketing, sales around the products, and a lot of it's education, right? Just explain to people this is how the product works, this is why we chose to do it that way. I think it's such an important point where you mentioned with CFDs, sometimes people taking it on faith that like they're getting the right price or this is all embedded in that. Like it's very important to us to like we provide full disclosure of like what goes into that price. We have a product in equities that's like, you mentioned total return swaps, right? We have a total return future product that's tied to some US indices where we like basically provide all these different fields of like, this is the interest rate assumption. This is the assumption of your spread parameter, right? So, and we have a whole white paper around it. So when we do products like this in crypto, same exact approach, right? There has to be complete disclosure of like, what are these numbers? Where are these coming from? Because their customers demand it. They're not just going to take it on faith that we figured out something. They want to track everything down to the bit down to the
Absolutely.
penny. And it's no different whether it's
Yeah,
crypto or equities or crude oil or whatever. That's like part of what makes us differentiated and trusted, right? Is that we're disclosing all that stuff so people know.
absolutely.
I was just going to ask, I know that there's like a huge retail interest in these types of contracts, but
Yeah.
are institutions kind of interested in these as well? And what type of impact do you think this could have on the market structure, kind of where the liquidity goes across these and the existing contracts?
Yeah, I mean, I think a trade-off that we always face is like when we have something new and innovative, we want to make sure that we provide something that is actually different. And then we also want to make sure we don't break anything that's already currently working, right? So that's kind of the trade-off that we have sometimes, right? And I think that, as I mentioned with crypto in general and the slate being a little bit blank more with crypto where we have the opportunity to try out new stuff. I think we also have the opportunity to try out some newer stuff when it comes to retail, right? When we think about some of our flagship products, right? There's an existing inertia and ecosystem around it of things that really really work well, and their sources of price discovery, right? Whereas something like a spot quoted, I think that adoption for retail, we can see how things go with retail and see how well it's adopted, and then like, is there room for an institutional type product with that spot quoted, right? And I think that's something that we can go through some iterations of seeing how that works. But I certainly have heard from people that they do like the accessibility of it. As I mentioned with that total return future, like people love that because it just handles all that stuff in the background. We're talking about asset managers who move around hundreds of millions of dollars, like all that being handled by the exchange, outsourcing and not having to deal with the OTC trading and paperwork and all that stuff,
Yeah,
right? So operational benefits behoove everyone, not just retail traders.
absolutely. I mean, we're all human beings. We don't,
Right.
if you tell me that I don't have to deal with something, then, that's going to be great, right?
Exactly.
And CME Group,
Yeah. Make that our problem.
Exactly.
Brian, I wanted to jump back onto the basis just because it was such a monumental thing, particularly last year. And for the listeners that don't know, Brian kind of eloquently explained what the basis trade is, but the short history of it is that we saw a lot of participation in basis trading last year with the price run up on spot Bitcoin and subsequently with the launch of these spot ETFs earlier in 2024. I just wanted to get your take. Like, did this surprise you at all as far as how popular Bitcoin basis trading was last year? And have you ever seen anything else like that in any other asset class? Maybe on the commodity side or even on the any other futures product that
Yeah.
you've ever
Yeah,
seen?
that's a good question. I mean, I come from an equities background, so a lot of my career I was focused on, what's called Delta One trading, right? Which is trading ETFs versus futures or the component basket, let's say S&P, Nasdaq, Russell, those products, right? We were trading the triangular arbitrage of the basket components, the ETF and the future all against each other, right? And finding those discrepancies, right? Now, when I first started in the business, those discrepancies could be quite large, right? Think about 2000, 2001, when the tech bubble was unraveling, right? There'd be gigantic opportunities trading that NASDAQ 100 basket against the futures where things could be, markets could be totally dislocated and there was, free arbitrage profits to be made, very easily. But those markets, it comes down to interest and dividends, right? So it's very, the dividend is relatively known, right? And you're really just trading the equity financing component. That's what's kind of unknown to me. I was kind of more on the prop side, so I didn't work at a bank, so I never really knew what that rate was, right? I was just kind of guessing what the rate might be and trading around it. Whereas the bank participants, they knew my rate is X, and I can buy below it and sell above it. I think about something like Bitcoin. I don't think anybody really knows what the rate is, right? So it's really kind of the eye of the beholder. Everyone's cost of capital are way different. So I think that's where there was a lot of juice in that trade. That even if the financing rate was just gigantic, there were severe costs and borrowing and lining up lenders to provide access to the underlying cryptocurrency. So these are really complicated trades. So dislocations exist. And I think there was a lot of juice for a lot of people doing that basis. But then, markets mature. But then as soon as you have markets mature, some dislocation gets introduced. And all of a sudden it could be tariffs being announced. It could be year end. It could be whatever. It could be some sort of firm like getting into financial trouble, right? So there's always something around the corner that's going to cause disruption to that financing. So I don't think that trade's going away anytime soon.
Perfect. Perfect. This is actually it's a good hook, a good segue because I mean, you guys kidding? We actually have a senior option specialist from the CME Group of all places, and cognizant and conversant with crypto as well. So we want to get into at this point, a little bit more of the mechanics of motivations and also products as well that are on offer. So generally speaking, people would assume, I suppose, that on the institutional side, users of a CME Group derivative products in specifically digital assets would be tending to be on the delta hedging side. But I mean, that might be a misconception. What is the actual reality, or what would you actually say about that in terms of the question?
Yeah, I'd say it varies about, how many participants will delta hedge versus not, right? And again, this is no different than we see in equities or other asset classes where you have certain institutional traders who want to take a view on volatility alone or are playing the Greeks in some ways, and they just don't want to deal with the delta, right? So they'll package that as part of the transaction, right? So that's one of the attributes of the operational access you have at our exchange, right? Is that you could attach that futures contract directly to the trade, right? So I want to do some sort of
Mm.
call spread and it's got a residual small delta. I attach that futures to the trade. It's all one package. It's nice and neat, right? So then you can trade that via block with a trusted liquidity provider, or you could do it on screen, right? So we have this functionality called user-defined spreads, right? So you send an RFQ to the marketplace. An RFQ is a request for quote. So you say, I want to be long a call option, long a 90,000 call option, and short a 100,000 call option. And I trade that spread, and there's some sort of residual small delta, and I hedge it out with a 3 lot of a standard size Bitcoin future, et cetera. And you could, send that to the marketplace through this RFQ process, and you get a screen quote where anonymously market makers are responding, and you can trade that's own central limit order book. So I think there's a lot of different ways you can trade that type of stuff. But to, long-winded way of getting to answering your question, it really varies on whether people use the delta or not, right? And so I think that people that are more retail focused are less delta hedging, and those that are more institutionally focused are more delta hedging, I'd say, generally speaking.
So, I mean, from what you say, it sounds like, there is that much activity, that much sophistication, and that much, it's that multivalent of a marketplace that it's a naive assumption of mine and maybe others to actually look at it in those terms that, it's not institutional stroke retail, your institutional capital markets and other large players are doing all sorts of things, and they're not necessarily, it's difficult to split them down into maybe your market makers, authorized participants, and other people serving the ETF, the ETF market, if you like, are not necessarily identifiable as people who are going in there cautiously looking for tools to hedge risk. That's probably not how you look at it.
Yeah, I mean, I think there's for us, having a diverse marketplace is absolutely critical, right? We can't have a marketplace where there's only one type of participant, because what happens is you have everyone's all the same way, right? That somebody might be, if you had all, long holders of Bitcoin that are, have the spot currency and want to hedge that risk by, either selling futures or selling call options, then everyone's a seller. No one's a buyer, right? It's like kind of futures 101. You need speculators, you need hedgers, right? You need institutions, you need props, you need banks, you need retail, right? And so for us, we look at our reports and see that we're kind of too heavy on any one of those. Like, that's not good. We would
Yeah.
need to focus on making it diversified so that the flows are balanced, right? You need short dated traders, you need long dated traders, right? So that's something we're constantly looking at, making sure that we're as balanced as possible, just because it makes for a more liquid marketplace.
Well, thank you, Brian, for your time today. It's been really awesome to learn more about the CME and your team there and all the amazing products that you guys have just recently launched and successfully, really, we could say. It's been kind of overwhelming to see how receptive the markets have been. I just really want to change gears as we kind of close things out and talk a little bit about product strategy and innovation. In the traditional market sense, we've seen a lot of interest for 24/7 financial instruments, whether it's trading for, equities or even tokenization trends that we're seeing with using blockchain technology. What are the folks at the CME Group looking at as far as the possibility of maybe introducing something like that?
Yeah, I think for that, and it's absolutely something that we're looking at, right? Because when you look at where the crypto marketplace is, 24/7 trading, it's been kind of part and parcel of things from day one, right? I think the challenge that we have is that as an exchange that's been around for multiple decades, right? We have technology stuff to solve, so to speak, to basically facilitate that. But we think that it's something that it can be figured out. It can be figured out with stuff like, do we ever look at having some sort of option that expires on the open on Sunday evening, right? Could it be extending hours in the evenings, right? And I think that a lot of it's going to come down to, making sure that we are providing consistency in the marketplace, and have a great approach when it comes to clearing. So I think those are all parts of it, is like the clearing aspect, the technology aspect, and making sure we can facilitate like a smooth transition. But I think it's something we're still looking at for sure.
Absolutely appreciate you coming on to talk so, openly and frankly about all the stuff, interesting stuff that you do. And it's coming down the pipeline, a little bit of that as well. Hopefully we can get you back on when you are
Yes.
free again to talk about more of this stuff. And thanks a lot for joining us.
Yes, I will definitely make the time to talk again. Thank you so much, guys. Appreciate it.
Perfect.
Thank you.
Perfect.
All right.
Thanks a lot.
Have a good one, guys.
Guys, I think you'll agree that was pretty illuminating from Brian Burke from the CME Group. If you enjoyed that episode, go wherever you get your podcasts to find 40 plus further scintillating episodes of CFB Talks Digital Assets. If you like CF Benchmark's content, cfbenchmarks.com is where you need to go. And after that, we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice.
This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.